Welcome to this week's episode of Accredited Investor Markets Radio. Each week we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Later, I will be joined by David Abraham, the author of The Elements of Power. The Elements of Power is a nonfiction bestseller. Its subtitle is Gadgets, Guns, and the Struggle for a Sustainable Future in the Rare Metal Age. Yes, where do all these rare metals that make an iPhone possible come from? And what are the implications that they are controlled by certain foreign countries, China in particular, and that the supply lines are mysterious and perhaps even unstable? What does that mean? Well, Mr. Abraham will help enlighten us. Please stick around for that. First, a few words. I read that the Baltic Exchange was for sale and that it dates back to 1744. That sounds pretty exotic. So I looked a little further, and this was in all the financial pages, by the way, at the end of February. The Baltic Exchange is for sale, or at least there are parties attempting to buy it. That sounds a little exotic. The Baltic Exchange is, after all, 272 years old, and it involves shipping. And it's called the Baltic Exchange. Again, sounds exotic. The Singapore Exchange Limited wants to buy it. Platts, which is a financial publisher, especially when it comes to commodities exchange information, wants to buy it. The CME Group Inc., which operates the Chicago Mercantile Exchange, wants to buy it. So Chicago, New York, and Singapore are vying for the Baltic Exchange. So 272 years old, the Baltic Exchange was founded in somewhat exotic circumstances in a coffee shop in the city of London in 1744. The merchant enclave was within the city of London, within London itself. The merchants congregated there and did things, and some congregated at the Virginia and Baltic Coffee House, which is located, or was, on Threadneedle Street. I would like to have streets in your town named Threadneedle. I think that's a great name for a street. So it turns out that the Baltic Exchange Limited has nothing to do with Latvia, Lithuania, or Estonia. It's really the name of a coffee shop in London. It became a more formal market, bringing merchants and ship owners together, providing a venue for traders to swap tips and information. Well, in due course, it helped the rise of the commercial might of the British Empire. And when we get to the 20th century, and as the 20th century wore on, it became more of a derivatives trading house. The Baltic Freight Index was founded in 1985. The Baltic Dry Index was founded to help determine daily freight rates for dry bulk cargoes. Maritime operators would go to the Baltic Exchange in order to learn the level of various global shipping markets, to help set freight contract rates, and to settle freight futures. All of this based on what all this has in common is that this Baltic Exchange was a place where futures in freight, futures in maritime assets were traded. So there you have it. It's about $120 million, looks to be the asking price. It's a profitable company, and we've gone from a somewhat exotic name, Baltic Exchange, to just another futures house. Well, don't conclude too quickly that there is nothing exotic about this. In 1903, the Baltic Exchange moved into what turned out and became a architecturally very significant and kind of treasured building in London. It was the scene, film location for Howard's End, a very fine costume drama of a E.M. Forster book. It's a beautiful place. Well, in 1992, the Provisional Irish Republican Army blew up the place. The entire thing was destroyed. And I like to bear this in mind when we have American presidential candidates blithely talking about revolutions, as though that's an unambiguously good thing. Well, the Provisional Irish Republican Army, too, was talking about revolution. And in this particular action, 3 people were killed, a 29-year-old professional employee. Oh, well, that's okay. After all, he was part of the power structure. But also a 49-year-old doorman and a 15-year-old girl. 91 people were wounded. So it turns out the Baltic Exchange Limited does have exotic elements to its story. Well, moving from the exotic to the mundane, but an important mundane thing. On AIMkts.com, right now, as of March 28th, crowdfunding under the Jobs Act, Title III, is an article you can tap on to learn the facts. Written by David Friedman and Matthew Nutting, who have authored a book on the topic. It updates the progress of Title III of the Jobs Act, which I call the 4 real crowdfunding provisions. Crowdfunding is often used to describe what accredited investors can do under the Jobs Act over the last 2.5 years because they can now be, quote, generally solicited, end quote. Accredited investors have to meet certain financial standards in order to be accredited investors and be able to invest in such private investing opportunities. Ordinary folk, those who do not meet those financial minimums, are the subject of the Jobs Act Title III and those regulations, which will enable full real crowdfunding to take place, finally in effect in May of this year. So this article, Crowdfunding under the Jobs Act Title III, updates these final regulations, and it links to the regulations themselves, and it links to various authoritative resources in the legal and financial worlds. So it's something which one can rely on. If you have an academic interest, certainly look at it. But also if you have a deep financial interest or potential financial interest, it's a place to get facts. And facts are the subject, factual sophistication, the minimal factual sophistication you ought to have. And when you're making investment decisions in certain areas, it's the subject of my final set of comments before we get to the very interesting David Abraham interview. In the Wall Street Journal, February 26, 2016, an article by Martina Stebis is entitled Investor Exodus Bruises Africa. So the title is talking about Africa, and indeed the first page of the article has a graphic of indices, market indices in Africa, which show great growth in 2013 and in 2014 and losses in 2015. So in 2013, on one of these graphs, one of these indexes, it's up 50%. Now that's great performance. But in 2015, the same index is down 15%. Country of Nigeria and its stock exchange was able to raise fresh capital in the amount of $500 million in 2014, but only $23 million in 2015. But the story isn't uniformly spread around Africa. Countries that are suffering the most are, as you might expect, those which are highly dependent upon energy-related commodities like oil. Now I'm going to read from the article. Kenya, which has a more diversified economy, and Ivory Coast, the world's top producer of cocoa, still are attracting investors. Analysts say that these countries are bucking the trend because they're energy importers and have sounder public policies that generate confidence. Ivory Coast's stock exchange, for example, bucked all trends and gained 7% over 2015. Remember, the Pan-African Index showed a 15% loss. And now I will read one final quote from the article. It's a quote of a person whose name is Laura Garitz, and she runs the US-based Wasatch Frontier Emerging Small Countries Fund with $1.1 billion under management. She says, quote, "One of the biggest flaws when investors look at Africa is that they think of it as a country and not as a continent, composed of very unique countries and companies," end quote. Yes, yes. Africa is not one big country. There are many, many countries in Africa. Africa is bigger than North America geographically. And what's more, if you were a political science geek like me or a reasonably well-educated person, you know that African countries, by and large, with some exceptions, were ruled by colonial masters into the middle of the last century. And you'll know that they weren't all the same, that countries with an institutional inheritance from England are in some ways generally different from countries with an institutional inheritance from France, which are different from countries with an institutional inheritance from Belgium, just to take one little factor. Well, it's not that little, kind of an important factor, in that none of the emergers from Belgian colonial mastery, none of them has prospered, whereas the institutional arrangements in English colonies are probably superior in general to those in French colonies, so Kenya, although Ivory Coast was a French colony. And then there's the factor that we already identified, that some countries are more dependent upon oil and other countries have more diversified economies. So looking at the entire continent as one country is kind of a deplorable level of ignorance. You have to know what you don't know in order to start making rational investment decisions, or you have to let those who know more make decisions for you. I should mention that in episode 31 of Accredited Investor Markets Radio, we had Joseph Lake, a global economist with the Economist Intelligence Unit, which is part of The Economist magazine, on this show. And we discussed Africa. We discussed specific geographical subsets of Africa, countries, groups of countries, and the differential rates of growth and why that was among such countries compared with other countries. So I urge you, if you're interested in investing in emerging markets generally and Africa specifically, to have a listen to the Joseph Lake interview. And that's number 31 in the Accredited Investor Markets Radio series. Now let's get to the interview today. We have with us here today David Abraham. David S. Abraham runs the Technology, Rare, and Electronics Materials Center, and that's part of the Institute of Global Security, and you can find out more at tremcenter.org. And for our purposes, more importantly, is the author of The Elements of Power, a nonfiction bestseller about rare metals. His career has included commodities trading, Wall Street, and the White House, where he oversaw international natural resource programs. He is a frequent speaker on rare metals and technology demands. David has also overseen operations of a clean water nonprofit, starting that organization's operations in Japan and Uganda, for example. He has advised investors on resource opportunities and has counseled congressional staff on resource risks. In researching the elements of power, David interviewed hundreds of people throughout the rare metal supply line in some real interesting corners across the globe. David is currently a Truman National Security Fellow, one of numerous awards and fellowships he has received. Perhaps most astonishing, David speaks Lithuanian. So David, labas.
Labas. Thank you for having me here.
Of course. Gere. Well, I read your book, and it's a wonderful book. I recommend everybody to read it. If you're curious about important elements of the international economic and political order, niobium is one of the rare elements you talk about. Could you explain what niobium does to steel? It's something very important that very few people are aware of.
Sure. It's one of those elements that are hidden in the periodic table that few know of because, well, it's not something you buy like corn, oil, or gas. It's something that's embedded in something that we use every day and we don't realize it's there. It's in steel. It's a steel strengthener. And what it does is help align the grains in such a way that you can use less iron ore, if you will, and use more niobium and have the same strength. It's so strong, in fact, that when the Eiffel Tower was built, it used 7,000 tons of steel. But if you use niobium steel, today's niobium steel, you would only need 2,000 tons. So it has a drastic impact in an area of materials that most may never understand because it's not something they use every day.
Well, then that means it's all around us, extremely important. Is it a lot of niobium that goes into a big old bar of steel?
No, it's really not much niobium at all. In fact, I kind of look at these materials, especially niobium and other rare metals more broadly, similar to the role that yeast plays in pizza. Yeast is used in such small quantities, grams to the size of the pizza. But without yeast, you don't have the crust in pizza, and you don't have pizza. Without niobium, you don't have that same strong steel. And that steel is critical to have that strength, for example, to stand up to earthquakes. You need a stronger steel to do that. Niobium, vanadium, other steel strengtheners do perform a similar role, but it's usually a dusting compared to the final products, just a few grams, if you will, in a ton of steel.
Okay, where is most niobium got and then put into the supply chain? Where does that start?
This is the real fascinating part, especially with rare metals, is that one country or even one mine can dominate the production of these materials. So it's monopolized. And what we see in the niobium market is that 85% of the world's niobium comes from one mine in Araxá, Brazil. They dominate the entire production. There's some spare production up in Canada, for example, but pretty much every piece of steel that uses niobium has a little chunk of the earth coming from Brazil.
Well, that's niobium in steel, but a lot of people, including many who watch House of Cards, for example, would be aware that there are rare metals in great numbers in something as small as an iPhone or in examples of green technology. Could you comment a little on the role of rare metals in those items?
Exactly. When you look at a phone today, it looks quite simple. The iPhone I have in my hand here is pretty much just a clear screen. But you don't have to look very far to understand where those materials are. In order to operate the applications, you need a way for your finger to basically reach into the phone. And the way that's done is through a transparent conductor called indium. Indium allows your finger to operate the apps. The brilliant colors on the screen are from two rare earth elements. One is europium, which makes the color red. The other is terbium, which helps make the color green. Your phone vibrates because of a magnet made from dysprosium and neodymium. You can go down the list of elements, and you'll find that most elements known to man are in your phone in some way.
And the phone, of course, has caused Apple to become the biggest company in the world, and that's a big story. But these metals loom large in strategic military, both strategic and tactical armaments, wouldn't you say?
They're in every high-tech application. Every with a plug pretty much is using certain materials that are once curiosities that scientists didn't know exactly what to do with, and now they're the staple of modern life, whether it's become silicon or germanium, which have been in semiconductors. And the key thing that we have to realize is that the military products we use today are some of the highest tech products imaginable. The military needs their planes to be lighter. They need them to be faster. They need them to be stronger. And to do those things, we really have to harvest more elements on the periodic table. You need rhenium in jet engines because jet engines get so hot that if you didn't have rhenium with its high melting point, the engines would melt. You need titanium in planes because it's a light, strong material. Beryllium in certain applications, again, because it's a light metal that's very strong. So depending on the application, you're going to use rare metals, and military applications are some of the most high-tech in the world.
Well, okay, sometimes one reads or hears rare metal, sometimes one reads or hears rare earth metal, minor metal, critical materials. Are there important differences among these terms?
This is a very important question to understand. We don't really have a good name to talk about materials that are used in small quantities and produced in small quantities. The Minor Metal Trade Association basically is the main organization that trades these materials, and they haven't even found a solid grouping of material, of elements that fit this category. But basically what we have here, and it's an important distinction, is people use the term minor metals or critical materials or technology metals to talk about materials that are used in small quantities and produced in small quantities. And what I mean by small quantities is materials that are produced in the hundreds of tons or thousands of tons annually, compared to copper, for example, which is close to 20 million tons produced annually. So a lot of the annual production can be produced in and put in just a few rail cars. So rare metals, the word rare signifies the amount that's produced annually or the amount that's used in a certain product. Rare earth elements, or some people call rare earth minerals, are a subset of 17 different elements. They're the ones at the bottom of the periodic table. And they're often mined in groups, so they're talked about often together. You'll get a set of rare earth elements that are mined and have to be separated together. But they're a subset of minor metals, a subset of rare metals, rather than all of them together.
That's something to bear in mind when one is reading declarations about this subject matter. I guess I would ask you also to comment on statistics that are kept about the amounts of this rare metal or that rare metal, and that you might see in the press or on House of Cards. How reliable are those things?
I spent almost 5 years traveling the world to understand the extent of certain materials being used. And copper, you have a good understanding of. Tin, but these minor metals, even the best experts, for example, Dudley Kingsnorth in Australia, has been following the field for 25 years. His estimates on the production of rare earths could go either way, 20%. So if he estimates the production annually is 200,000 tons, it could be 160, it can be 240. There's a wide range of guesstimates, but since these materials are traded in backroom deals, because there's very little clarity, because often one mine or one company produces most of the material, that the amounts are not spoken about very easily. And we don't have good understandings of a lot of times where the material flows or how much flows.
Well, maybe it's time to talk about what everybody thinks about, those who are aware of rare metals, which is China. How large does China loom in rare metals? And when we think about all of the consumer and military applications, and one wonders whether there are American or North American sources for rare metals.
China looms very large. According to the British Geological Survey, they studied about 45 critical materials and stated that China produced 22 or so of them. So they dominate the production in ways that few have failed to grasp. So if you look at the oil market, at one point, Saudi Arabia produced 16 or 18% of the world's oil, and everyone talked about Saudi Arabia being the dominant world producer. Well, when you look at rare metals, 97% of the world's rare earths until a few years ago were produced in China. Now that number is around 90%. Antimony, indium, tungsten. China dominates the production of these materials because of good geologic fortune and also a very interested government ensuring it could supply its own resources. Lower environmental standards, lower labor costs allow China to really extract these resources at such a low cost that in the 80s and 90s, mines in France, in the U.S. Started to close down because they couldn't compete against China's low costs.
So this is a serendipitous day in a way for this discussion, because American company Molycorp, which you write about in your book, had its Chapter 11 plan of reorganization confirmed today. After going into Chapter 11, I guess it was a year ago or so, and went in because prices had fallen, the facility from which it extracted minerals was not operating well, and its interest payments became too onerous. And that was basically the only American rare metals mine. Isn't that correct?
That is correct. And in fact, it was the mine that people turned to say, does the Western world have a chance to compete against China in producing rare earths and many rare metals. And what we found out is that it's very challenging to produce these materials. It's one thing to have them in the ground, but you have to understand that there's a long process to get the material from the ground and into a usable state. And there is no cookbook, if you will, for rare earths. It's a trial and error, a chemistry experiment where heat and different acids need to come together and balance in a way that you can produce materials at an economic level. And what we saw was the prices never went that high. Molycorp was never able to find that balance to optimize the production. And because they have higher debt payments, or they have debt payments compared to companies in China where we really don't know their financial structure so well, they couldn't compete, and they had to close down. It highlights the challenge when you're trying to emulate what works in China in terms of processing and production. It doesn't always work well in other countries because of the factors that we have to consider elsewhere, whether it's environmental standards, most notably, or other financial structures where the government can come in and kind of give a cash infusion to a Chinese company. It's just a challenge to compete with the same technology. Where there is opportunity is to find those companies that are pushing novel ways to process these materials. When they can find ways to process them more cheaply, more opportunities become available. And that's the way to, if you will, move the resources from China or elsewhere, whether that's Brazil or Chile, to new markets.
So those are some economic and strategic implications given the dependency on China and the ability of China, if it wants to possibly manipulate supply?
Any country that has, or any mine that has the monopolistic domination of a market can determine price. I think that's just an economic 101 type of argument. So China does have that ability. However, you have to understand when we do talk about China that there are many players within China. You've got Beijing, you have the local government, you have individual companies, and each one of these actors have different goals. So, for example, you hear a lot of talk about Beijing wanting to clean up the environment, and it's true that they are trying to make strong strides in cleaning up the environment, which means shutting down certain mines or investing in cleaner technologies for production. But on the other hand, you have the local government, and they have different incentives. They may need currency, and therefore they're pushing their companies to produce. So you have a battle between local and central governments, and you have individual companies, and the rule of law isn't as strong there. So while you do have one country that's monopolizing, you have to start to look a little bit deeper to understand the factors that are in play.
Well, I think that's a very powerful point. Stepping away from those considerations for a moment, can you discuss, or maybe it's too big, but give a try to discuss how the use of rare metals has changed over a period of time, say between 1990 and the present, that is? Are the same rare metals, I guess we should expect that the prominent rare metals might shift from one era to the next, even in a shorter period of time of 25 years?
We find in general that we use more and more materials. So whether it's paper between the 1970s and the 2000s, which increased even though we had increased in use, even as computers became more dominant. We were up to using about 2 pounds of paper per day per office worker, even though we had computers which had negated the need for paper. We have products that kind of duplicate other products. I have a tablet, I have a smartphone, I have a laptop and a desktop. And they all serve the similar function, but we keep using more and more material. And at the same time, the products that we used to have that weren't electronic, like toothbrushes, became electronified. And each time we go from a standard product to an electronic product, we're switching our resource base by using more and more of the materials and more of often rare metals. because we're asking our products to be stronger, faster, and more powerful. And what we found out when you talk about the time frame about the 1980s or 1990s is that for many rare metals, we have mined in just the past 25 years roughly 4 times the amount of rare metals that we did from the dawn of civilization to the 1980s. We're finding new uses for new materials, and this is a wonderful thing because it allows green technologies to prosper, it allows our iPhones to fit snugly in our pockets, and it allows military applications that we once only dreamed of could be possible. But at the same time, what we really have to start understanding is that the supply lines to produce these materials is more challenging than we may expect. Now, I don't talk about running out of X material or Y material, although some materials are very scarce, like tellurium. The challenge that we have is that supply lines can take 15 years to develop. 15 years. So that means material that entered the market last year was planned when we were dealing with the Y2K bug. We couldn't look forward and understand that we would have cell phones and so to such degree. The same is the case now. We're planning for mines that are going to be opening in 2025, 2030. And the challenge is that technology is going so fast. Technology is spreading around the world far quicker than we've ever imagined. Within 4 years, 6% of the world owns a smartphone. So we're getting to a point where technology is spreading out so fast, but our material supply lines are going to be challenged to produce the materials at the right cost, the right economic, environmental cost, at the right time. And I see this mismatch occurring. It's not a next year thing, but this is a 5 or a 10-year thing.
So I guess I was thinking about recent turnabouts in oil production, how it looked like the Hubbard theory of peak oil was correct until fracking came along. But that's fundamentally different because the supply lines for oil production are assured worldwide. And if you find a way to get more oil, well, you're just going to have more oil in the supply lines. Whereas the issue with rare metals is not only that there's many more of them, but the supply lines are iffy from the very beginning, no matter how much you're able to get out of the ground.
Sure. They're tenuous. And because they're tenuous, you see companies shying away from materials. How do we use a magnet that doesn't use dysprosium or neodymium because we're worried about supply? That's strange. I couldn't imagine Ford saying, let's see if we can completely change the engine so that we won't use oil in 4 or 5 years. That kind of drastic change is what you see when people are scared and don't know where their materials are coming from. And what we find is that, one, that's not always the best course of action because then you're, if you will, seeding boxes on the periodic table to other places or other countries. And if they have better ingredients to make a product, they're going to make a better product over the long run. But when you talk about the supply lines and you compare it to oil and gas, they're just more challenges in producing these materials at the right grade, where oil and gas is far easier to do, and the supply lines are far more transparent and robust.
Well, given the stakes involved, and what you were just saying about some companies redesigning microtechnologies in order to accommodate differential amounts of supply of different ingredients from rare metals, are metallurgists doing really well, and are there more people going into metallurgy, and we're having a flowering in metallurgical science, both within the schools and within the companies, say in North America and Europe?
Chris, I wish that were the case. I think we see this golden age of entrepreneurship, but we don't see the golden age of metallurgy. People want to do something that's quick. They're shying away from sciences in general, and metallurgy is just not sexy, nor has it been getting much funding from governments, especially Western governments. And people who are educated in the material science and metallurgy don't always find jobs there because they might rather work somewhere else. There are real challenges to find people who want to engage in this field, and the support isn't there as it once was. The government, for example, was funding research into titanium in the 1950s to the tune of hundreds of millions of dollars. Well, last year, the government funded critical material research, so basically all minor metals are critical materials at 20, 25 million per year. So the government doesn't focus much on it. The individuals don't focus much on it, but what you really have to see is if you look at a spectrum and you have the iPhone on one side of the table, on the other side, if you will, would be the mining aspect. And people don't realize that the higher tech our products become, the more we're reliant on material that's coming from the ground. And I think if you draw that continuum, that maybe over time people will start to focus more on, hey, where do we get this stuff from? And my hope is the book was really to open people's eyes to say that although I'm focusing on minor metals, I'm really focusing on the resources of the earth. And it's these resources that are making our high-tech lives possible.
Just to sort of go at that same point from another direction, I'll offer an explanation and you can tell me what you think of it. These brilliant minds that know something about metallurgy, well, I guess they could do metallurgy and make a pretty decent living, or they can parlay their expertise in metallurgy into investment or entrepreneurial stakes in companies that might blow up and make them many hundreds of millions of dollars. And the lure must be very powerful to engage in the investment world rather than in the mining world. And if that's true, that has implications for investors as well, don't you think?
I think it does. And I think you do need experts on the investment side as much as you do on the extraction side. Because what we find in the minor metal world, take rare earths. When the rare earth bubble came in 2010, there was something like 600 or 700 different rare earth companies. Companies were coming out of the ground saying, hey, we're raising money because we have a rare earth facility. So when you have that many companies coming about and each trying to extract $1 or $2, there aren't that many dollars to go around. So if you do have people who are in the investment stage and say, hey, listen, the world only needs 3 mines anyway, and these are the 4 or 5 that could do it, you really could allocate funds more effectively. Now it's almost the Wild West. When prices spike, whether it's indium or antimony, companies will say, hey, we have this material. So I think that while metallurgists may go into investments, I think there's opportunities there. The question is who, I think the point that you get is right, is who's left to actually do the real work.
Well, and when it comes to investors and looking at it from their perspective now, you just mentioned the spiking of prices, which kind of implies a great volatility in prices. And you talked earlier about the timelines from the beginning of extraction or the search for places to extract to actually marketing the stuff being quite long and a little bit mysterious. In order to help investors at least begin to think about these things, could you comment on those things?
There's huge volatility in these markets. One other thing that's really important to understand when you look at the minor metal market is a lot of these materials are byproducts. So they're not mined for themselves. They come out during the process of refining other materials. And in fact, they were once impurities, if you will. So copper, the ore contains selenium and tellurium. And you're not going to have a selenium mine, if you will. You're going to get it through copper. So some of the challenge is that when price spikes, there's not always the production that would increase the amount of selenium in the world. What would happen would if the price spikes, the price just continues to spike because more supply isn't added. What studies from the Colorado School of Mines show is that prices increase, if you will, in a step pattern because new technologies have to be born or new technologies would have to be used to process to offer an incentive for more production to become online. So it's not like oil where you would just pump more oil if the price were to spike, because then you know exactly you can moderate the production. A lot of these byproduct materials are just produced on their own. So you've got that byproduct production, which is just a little bit different and creates challenges in ways that people may not understand.
I like the fact that we've been drawing on the oil analogy because of how it doesn't work as an analogy. But one other aspect of oil that you made me think of just now is if you're investing in the price of oil and you're going to come out well if oil is at, say, 45 a barrel, you can hedge your risks by buying futures because there's an active futures market where you can sell access to this price or that price and hence protect yourself from disaster. There does not appear to be any such futures market in any rare metals, at least none that I'm aware of. And so it sounds like, based on summarizing, that there's price risk because of the volatility, there's technological redundancy. Maybe this rare metal won't be as useful by the time it starts getting mined and sold, or might be replaced. There are supply line issues you spoke about, and regulation that you did not speak about, but anytime you're building anything in a Western country, you have to deal with regulatory risk. And there's no futures market to hedge your bets. Well, what's an investor to do?
It's educated gambling. But the sector is not all about, I'm gonna invest today and then in 10 years later the mine's gonna be produced. People are often looking for next steps, and they'll get in and they'll get out. And it's a crazy way to fund a mine. If you look at CBMM, the largest niobium producer in the world that I was speaking about earlier, they're private, and they had private funding that enabled them to go slowly, to build up uses for niobium, to find new markets, and they were patient investors. Today's investors aren't as patient, and it's completely understandable. But it's a hell of a way to build a mine, and it creates challenges for CEOs who are looking for resources, not just in the ground, but in people's pockets. So it's a real challenge. You must know who the people are at the top of the company and really focus on their previous experience and the team that they hired. And then hopefully you're getting some answers that can vet through their experts who know that particular element and that particular market.
Well, I don't want listeners to come away thinking that your book is overly intense, although it's chock full of information about extremely important things. And I certainly don't want them to think that it's dire in its tone. For one thing, the description you give of you visiting the niobium plant in Brazil is very charming and very much fun. It reminds me of some of the fanciful places the detective would go in a 1970s or 1980s detective series, where they'd go to some secret, very well-heeled company, and the mystery would unfold there. Just wanted to mention that the book really was a joy to read.
To talk about these materials and without giving stories, it makes it dry. But you're with me when I'm off the coast of Indonesia, when I'm speaking to illegal metal traders who tell me how they pay off the police, or where I'm in a rare earth facility in China, trying to see how they smelt some of the materials, and my eyes start to water, and my nose starts to run because of the air is so pungent. You have to see these things firsthand and experience them to understand the true nature of the supply line. And that's where I try and bring you to understand where it comes from and how it gets to us and the steps along the way.
David Abraham, who wrote the book The Elements of Power, of which we spoke today, thank you very kindly for talking about the book on this program.
Thank you very much for having me, Chris.
Accredited Investor Markets Radio is produced by Stephanie Strait. It appears every week and can be found on www.accreditedinvestormarkets.com. I am Christopher Cahill. Very glad you could join us, and let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.